Welcome to Pete's Property Podcast, brought to you by Buyers and hosted by Pete Wargent, buyer's agent, finance and real estate expert, and all-round property guru, plus published author. Join Pete for 30 minutes as he chats all things property with a new guest each week. Learn practical tips from the movers and shakers in the property industry and well-known personalities sharing their property journeys.
G'day, welcome to this week's episode of the Pete Wargent Property Pod. I'm really excited this week. Got a guest with some unique insights, Kent Lardner from Suburb Trends. Kent, welcome.
Thank you, Pete. Thanks for the invite.
Yeah, I've been really keen to get you on for some time because I've been following your research and insights for a long time, and you do something that is quite unique and different, and definitely for people interested on the buy side of property, it's definitely research that you should get in front of you. So let me just do a quick biography. So Ken has been around the traps over the years. Way back in the late 90s, was with GE, now Genworth. So learned a lot about the design of automated valuation models. Then you had a period of time at Pricefinder as COO. For those of you who aren't familiar, Pricefinder is one of the big players in the sector, things like price estimates, systems, and so on. Obviously, a big background in market research. Did a stint with CoreLogic as well, heading up the analytics team, and then also did a contract with Real Estate View to redesign their website with now over 2 million visitors a month. Now, today, Ken, give us a quick overview about what you do at Suburb Trends, because you're doing a lot there to help investors and businesses across Australia.
Yeah, thanks, Pete. I've got Suburb Trends very much focuses on taking the old Excel type spreadsheet data sets and then giving them some value adds. So I'm servicing mainly buyers agents, but it's a bit of a mix. I've got investors come through. A lot of investors come in and want what they used to get in the magazines. People go through the airport, remember the investment magazines, and you'd go straight to the back pages and look up the data tables. So I'm looking to fill that gap since those magazines stopped publishing, fill that gap but in a spreadsheet format. So investors are buying that. Another market that's opened up for me recently, and focusing very much on the off-market and a very detailed analysis of the off-market, so properties that are owned for 10 years or more, and really carving that up and looking at the price segments that apply to each region or each suburb, only looking at properties that are owned for 10 years or more, and then understanding the likelihood of those properties coming on, what the percentage of them that will be coming on the market, and then actually building some systems to actually help selling agents, buyers agents reach out to those owners.
The property magazines, which are now largely out of print, they always used to have in the back section, they had these lists of suburbs that had various data. A lot of it was based on median price changes over, say, 3 months and 12 months and 5 and 10 years. And people used to love that section because they'd go to their suburb and see how the market had been performing. I guess there was always a bit of a limitation on how useful that information was, though. I think certainly at the suburb level, some of the short-term numbers were sort of impacted by small sample sizes and so on. But what you do is much more granular. So you do some stuff at the sort of the SA2 and SA3 level and suburb level, but I guess you're doing more detailed research into trends by property type and different locations. So what is it that you're doing that's different?
Yeah, I think the main thing I focused on, and one of the things that drew me into the suburb level and market analysis and away from property-specific modelling or AVMs, was looking at the distribution of prices at a suburb level. And you could see how odd they were. They were very odd shaped and bimodal or trimodal. You go to a beach typically and you've got one market that exists along the beachfront and another market that exists a little bit inland and another one that might be up the hill. What I found through trying to build indices, I found that a lot of the Australian suburbs, a lot of those coastal suburbs especially, misbehaved with a lot of indices. So that was probably the bridge for me to move into the suburban market level analysis. What I started to do is play around with some models, predictive models, machine learning models, forecasting, And I started to experiment with different ways to aggregate regions or areas. So you could go from a suburb and go up one tier, which is an SA2 or a statistical area 2. That's about 2 or 3 suburbs big. That works well, but sometimes it still falls short and it has the same problems that your suburbs do, especially along the coastlines, but pretty good. And then I went up one tier again to what's called a statistical area 3 or an SA3. In the old days, we used to use local government areas extensively, and then the amalgamation started. So Brisbane started to roll out and it became a blob, which was a city size. Gold Coast did the same thing. So you end up with these massive LGAs that became a little bit useless in models because you were treating the outer burbs of Brisbane in the same way as you were the inner or the bayside suburbs, etc. So the Australian Bureau of Statistics designed the statistical areas with one thing in mind, statistical relevance. So I started to use the SA3s in the models, and I found that the distributions, the price distributions and other metrics had a very nice shape to them. And the models started to show up very differently. So when you plug it into your statistical models and stand back and say, is this significant? Does the model work? Are all your key measures to say, is it a good predictive model? They were looking pretty good at this SA3 level. So I inherited the SA3 as my main go-to for modelling and predicting. And then you can actually take the learnings from that and apply those down at the suburb level. So it's a bit of a hybrid mix, but most of your modelling's done up at that SA3 level.
Yeah, that makes a lot of sense. And particularly when you're looking at the different property types, you must have seen some really interesting trends over the past couple of years, because I think the word unprecedented is probably somewhat overused over the past couple of years. But obviously, you could see some of the demographic trends where there was this kind of race for space and people were heading away from the denser areas. Did you see anything flashing up in your statistics to show that maybe the larger detached houses were outperforming over the past couple of years, say the 4-bedroom property type?
That was the first thing that I noticed. So I was looking at I call it stratified. It's probably the incorrect term, but I think everyone understands stratified. So just looking at the medians by bed count and then looking at how they start to vary. And I got whiff of this happening in the US as a result of COVID, and whiff of it happening in the UK, and people, the exodus to a larger property to work from home. The first thing I did is look at the trend and the 4-bedroom shift in 4-bedroom medians versus 2 and 3. It was a giveaway. It was standout. So that was the first thing I noticed as a result of the whole COVID era. Then the second thing we noticed was how quickly these commutable lifestyle locations really their inventory levels shrank rapidly, and we knew from there, as soon as your inventory levels go from 4 or 5 months, and we'll talk about that in a moment, but they go from 3, 4, or 5 months of stock suddenly down to 1 or 2 months, the prices are about to follow. And we saw that happen Wollongong, Gosford, to a lesser extent the Blue Mountains, but they were quite strong. And a few of the markets like Victoria, throughout Victoria, they didn't behave normally because their lockdowns are a little bit more severe. But certainly, if you looked around Sydney, you looked around Brisbane, those markets, those commutable lifestyle locations surged and are still strong today.
It's a really interesting point, because I guess a lot of people who are looking to buy property, particularly investors, but also to some extent a home buyer as well, would want to know, well, what's the outlook for the market I'm buying in over the next year or two? And I guess one of the things you've identified there is that when you've got inventory levels that are tightening, and particularly if you've got, say, less than 3 months of inventory, then that's probably a tight market, probably a rising market and a strong market for sellers. And that's ultimately what drives price growth. But how do you actually come to calculate a figure for inventory? Is that done by an algorithm that you've developed?
Yeah, so typically at the simplest level, we're counting the average amount of listings and then the average amount of sales per month. So if we look at, say, a suburb if there's 50 listings on average and 10 properties selling per month, 50 divided by 10, 5 months of stock. There is a couple of differences we apply. What I do is you need to forecast your sales volumes. So you can count how many listings there are today, but to count the average sales, you've really got to look in the rearview mirror and you're looking at a monthly average. What I do is I fit that into some machine learning models and then predict what the model says will sell next month. And then I do that again 3 months into the future. So machine learning has a role to play, but specifically forecasting the sales volumes, whereas listings, I take the current count. You can forecast listings as well, but that's how I approach it. What's happening at the moment, you can see Southeast Queensland still very, very strong. Now, I know that there's a lot of headlines out there and people, doom and gloom and whatnot, but I just let the data speak for itself. And we've still got extraordinarily low levels of inventory in and around Brisbane, Gold Coast, etc. Things are starting to soften in other markets, but there's no collapse. It's just slightly nudging its way back to normal. So I'm not seeing any alarm bells. But in terms of investors and what they're looking at, probably the biggest concern and alarm that I have at the moment is that people will look at a very short-term window of, say, an apartment market and say, wow, the apartment market's booming. Well, it might be booming in the last 12 months relative to coming off a low base a year ago or low base 2 years ago. And if you only look at a 1 year window or 2 year window, you may draw the conclusion that the unit market is booming. But if you step back and say, how does it perform over the long term? How well has it done over, say, a 10-year period? You typically find that it's, give or take, around half the capital growth of houses.
Yeah, well, you've preempted my next question then, because I was going to ask, I've just penciled down here, how much do you think investors should think about short-term versus long-term? Because I guess what springs to mind is if you've got an infrastructure investment or a one-off boost to a location, that could result in falling inventory. And I guess the most obvious case in point in Australia would be the mining investment boom from the early 2000s, I guess, to around 2011 or 2012. And there would have been some locations there where you saw extraordinarily low inventory, very tight markets and big booms in prices. But I guess in a lot of cases, those were one-off factors. So you think investors should look at sort of long-term performance as well as some of those short-term metrics, I guess?
Yeah, my favourite word now is constraints. And what we're looking for is constraints and scarcity that's going to remain. And what we found, and tying it back to, say, what's happened with the exodus, of the COVID exodus, is you've had an increase in demand in markets that don't have land constraints. The constraint has been more human-related or time or available supply in the short term. So demand has gone up, supply's remained where it is. There's not been any new building approvals. There's not been new land releases. But we only have to wait maybe another 6 or 12 months and we'll see those start to come back to normal or start to rise to meet the new prices in some markets. So it's going to be fascinating to watch what happens in the next year, because there are markets where we really don't have land constraints. Unit markets, we don't necessarily have too many air constraints if it's a high-rise market. So I think the key is to only look at the long term, not look at short term. If you're looking at short term, maybe the asset class of property is the wrong thing to be looking at. So for my perspective is this is a long term play. You should probably only look 10-year plus. If you're looking at short term, you're probably going to be drawn to apartments which aren't going to give you much long term growth in comparison to houses.
Yes, I guess we've seen certainly over the past 10 years that units have underperformed against houses in most parts of the country. You mentioned there just before Wollongong, one of those places that became more popular through the pandemic. I had a couple of clients who higher income earners as well, saying that they wanted to move to Gosford over the past couple of years. I remember Gosford of 20 plus years ago, and it was somewhat in parts sort of a secondary location, but it's become phenomenally popular over the past year or two because people haven't needed to be in the office so much. I'm sure you've seen that flash up in your statistics. You mentioned Southeast Queensland. Are you still seeing falling stock levels in places like Moreton Bay or the Logan Shire?
Those areas have still got lots of land. They don't certainly have the same constraints, but your Brisbane Inner East is one that I look at a lot at the moment. So those inner Brisbane suburbs and the coastal suburbs or the coastal areas like your Gold Coast. So I think, the Gold Coast is probably the poster child right now for mine. And then the inner east, in and around the Gabba there, a lot of infrastructure going in. And then, look at what's happening, dots on the map for infrastructure projects around Southeast Queensland, quite phenomenal. So when you couple that with coastlines and boundaries and constraints to supply, the future's still looking very, very solid for Southeast Queensland, but in those pockets of constraint.
Yes, and I guess with the Olympics coming in 2032, places like the Gabba, or specifically the Gabba, will benefit. New rail line, stadium upgrade. I guess the stadium being demolished as part of the Sustainable Olympics, which always raises a smirk. But what about other statistics? Do you look at things like gentrification or, say, crime statistics at the suburb level? And I guess following on from that, what do you actually, can you deduce anything from levels of crime in an area? Does that impact property prices?
I've not spent a lot of time on the crime data because I can only access it in limited states and limited scenarios. So I've not spent a lot of time on it. Now, in the select scenarios where I have looked at it, it just hasn't stood out as a significant variable. What has stood out is a metric that's strongly correlated to it, which is called the CIFA index. It's a socioeconomic index. It's a 1 to 10 index. And what it does is it measures down to the neighbourhood. So at an SA1, say typically 200 homes, gives you a 1 to 10 score, and it's created by the Australian Bureau of Statistics. So it's this 1 to 10 score, with 1 being the least socioeconomically advantaged groups and 10 being the most. That definitely stands out in all of the models. And the beauty of that is it's granular down to a neighbourhood. It can be done at a suburb level, done at an SA3 level. The terrific thing about it is it's uniform across the country. So when I plug it into models, it's broadly used. It is correlated to crime. So, you will see certain crime rates correlate to the CIFAs of 1, 2, and 3.
Do you want to save on buyer's agent fees? You could save thousands with Buyers Buyers. As Australia's most extensive network of buyer's agents, we can lock in highly competitive prices. Plus, our national network of buyer's agents are some of the best in the business. So get the Buyers Buyers advantage and talk to us today. Call 1-800-975-051 or visit buyersbuyers.com.au.
When you see a suburb gentrifying, I remember Peter Kalizos saying you start to see more dual income households, and there's other metrics that you start to see. But actually, sometimes you can just see this stuff with your own eyes. The arrival of new coffee shops and cafes. Place like Oxley in Brisbane springs to mind. Wasn't the sort of place you would hang out 20 years ago, but then the Woolworths came along and Zarafa's coffee, and then now you see a lot of the older stock being pulled down and new builds going in. Now, obviously, we've just had a census, and the census is an absolute trove of information for people like yourself. Any trends you're expecting to see coming out of the census? I think one that I might be keeping an eye out for is whether home ownership rates might have actually lifted unusually. We haven't really seen that over the decades. Home ownership rates have generally been falling, but I guess with various first home buyer stimulus measures, that's a possibility. The other thing that springs to mind between the census, we've been building a lot of inner city apartments. I guess we'll see more density, more renters in some of those markets. But is there anything that you look at in particular from the census, like snapshots of incomes at the suburb level or anything like that?
Yeah, I obviously the CEFA is one that stands out for me. Income levels, another one. You hit on the one that I'm most interested in is the trend in rental tenure and looking at that increase. So typically with that increase in rental tenure, we've seen in between census, that's starting to rise up. So we're kind of at the moment expecting it to be around 35%, but I wouldn't be surprised if we don't see that tip the 40% mark. And we're on our way to some of those European countries where it's 50% plus rental tenure. So I think that's where Australia is going. The affordability issue is going to exacerbate that without a doubt. So we're seeing, obviously there's a very strong correlation between units at high density and high rental tenure as well. So suddenly the persona or the profile of some of these inner city markets is radically changing.
Yeah, it does kind of make sense. I think the Reserve Bank has shown previously that when new arrivals come into Australia, they're almost invariably renters, particularly students, but actually permanent migrants as well, because they don't necessarily have security of employment. They don't really know where to buy or even whether they can buy. So I guess having run a high immigration program over the past 15 or 20 years, it would kind of make sense to see an increase in the rental demographic and actually people, changing jobs and locations more than before. And I get build to rent, I guess, is another thing that's likely to become more popular over time. Now, on the subject of the rental markets, this has been a really unusual or surprise trend, I think, over the past couple of years, and that is vacancy rates are hitting rental crisis levels in a lot of parts of the country. Not so much the inner cities where people have kind of moved away, but particularly in the regions of Australia, unless I'm missing something, it just seems to be tightening, and there's not a whole lot being built in the unit and apartment space now. What do you think is going to happen in rental markets around the country? Is that rental crisis going to worsen, or do you think there'll be some pushback?
The first markets that were impacted were these commutable markets, the exodus locations. So people left the cities. They came in with a bag of cash. They were obviously economically better off than a lot of the lower income families in the regions. So suddenly we saw regions like Lake Macquarie East or Newcastle or Gosford, etc., plunge below 1% vacancy rates. Now, the areas that have a lower socioeconomic advantage scores, like the CEFA scores, they will have only increased in rents marginally because that's what people can afford. But in those areas where you find that the socioeconomic advantage is average or better, the rents have increased substantially. So the other thing that you step back and say, well, where are the rental going to come from? Will demand ease as people rent and then find a property to live in and move out? Well, that hasn't happened at enough scale to really change the dial too much. So then you look to building approvals, or you look at new stock, or you look at other things that could replenish the rental stocks, and there's just not enough out there. And you go to places like the mid-north coast in New South Wales, there's hardly anything in the pipeline in terms of building approvals. So there's no solution in sight. And I like to pick on that the mid-north coast is lower socioeconomics, not a lot of infrastructure spend, very forgotten. So, these markets are doing it tough, and a lot of these lower socioeconomic families doing it extraordinarily tough.
Yeah, because I guess unlike in the market for housing prices, you can't leverage rents. So I think historically rents and asking rents have been somewhat more closely tied to income levels. And as you said, in some areas, that's becoming a real issue. We've certainly seen it on the Sunshine Coast to the extent where we're seeing actually some properties sitting vacant now because people just can't or won't pay the asking rents. They've gone so high in some coastal locations. Actually, on that topic of coastal markets, you mentioned the affordability challenges, particularly for family homes. What do you think about the prospect or outlook for markets where you can still buy family homes for, say, $450K, like somewhere like Bundaberg or Cairns? Do you think those markets are likely to see more demand just from the affordability perspective?
I do. I really think affordability will be a big driver. So if you've still got those elements that could create, because there's two arguments here. We're looking at affordability as our objective, or are we looking at capital growth, buying affordable and watching it grow? So there's two arguments. If you look along the coastal strips, and you mentioned Bundaberg, et cetera, there's still a lot of these coastal regions that have supply constraints or land constraints. They're bordered. You've got, say, the Bruce Highway and then the coastline. There's a lot of these markets that I think are worth looking at, where there's infrastructure and constraints and affordability. So I think one of the hot buttons in the next decade is affordability. People squeezed out. First home buyers, pretty much there's no option for you in Sydney other than looking at a unit if you're a first home buyer who's not from a wealthy family. So there is going to be this big push into these affordable locations. So there's two arguments, and there's those looking to invest and get capital gains and lifestyle. The other option is, what should we be doing to look at affordability long term for future generations? And this is where we get into the argument where we need to look inland, not along the coast, because we want to deal with constraint and we don't want land constraint. So we need another 2 or 3 Canberras for the next generation or two.
Following on from that point, I've read a couple of things recently. Firstly, that property investors tend to invest below the median price for the location they're investing in, which I think kind of makes sense. Maybe in some cases they want to get into the best market they can and maybe buy a property to add value to. So that intuitively makes sense. But I also read that potentially some of the properties in the most affordable quartile of the market are doing better at the moment, possibly because people are getting wary about rising interest rates at the top end of the market. Is there anything in your stats to back that up?
What I found, I analysed and divided up Greater Sydney into quintiles and looked at their growth rate over the last 2 years. And it was the top quintile grew at a rate 5 times larger magnitude than the bottom. So if you looked at Sydney as your snapshot, it flew in the face of that logic entirely and said, well, the rich got a lot richer and there was a big demand there. Select suburbs in the eastern suburbs north have in excess of 40% fully owned without a mortgage. So I think the mortgage argument doesn't necessarily apply to a lot of those Sydney suburbs. I think for a lot of investors, they still use the old cash flow and yield calculation when they're selecting their suburbs as well, which is does have its limitations because you miss out on a lot of property. So whereas if you calculate your yield at a property level, not taking the median sale price and the median rental price to calculate your yield, you'll uncover a lot more properties by not doing that and looking at it and using property-specific data. So I think first and foremost, look at all your capital growth metrics and then look for individual properties. And the way I like to do it is do it at an SA3 level, then drill into individual properties, looking at the suburb stuff as the final DD step.
Yes, I do sometimes wonder about some of these mortgage stress surveys where they seem to claim that there's, most households are in mortgage stress, but in a lot of cases, you might have a third or up to a half of properties owned with no mortgage at all. So that doesn't always make any logical sense to me. But I guess that's an ongoing debate in Australian property, and we'll no doubt hear more of it over the next year or two as interest rates rise off record lows. So, Ken, that's fantastic. It's great to just scratch the surface of your many thoughtful insights. If people want to find out a little bit more about Suburb Trends and get the more detailed insights from you, where should they go for more? Yeah,
visit suburbtrends.com. I've created a free membership tier with lots of maps and information there. So get in there, become a member, free membership, and explore there, and then have a look around the site, see what else you like.
Fabulous. So strong recommendation. Check it out at the website. We can stick a link in the show notes as well. Ken, thank you so much for today, and look forward to chatting again in due course.
Wonderful. Thanks for the invite. Thank you, Peter.
Cheers.
Thanks for listening to Pete's Property Podcast, powered by Buyers Buyers. Don't forget to subscribe and join us next time as Pete chats all things property with a new guest. And just a reminder that the information provided in this podcast is general advice only and doesn't take into account your personal financial situation or needs. You should always consult a licensed professional to discuss your individual personal circumstances.